back again, and in this group of videos we're going to be talking about the statement of financial position, the cash flow statement, and how that all ties into the annual report. So in this first short video we're going to be talking about the balance sheet specifically, or the statement of financial position. So the balance sheet is where you'll find your assets, your liabilities, and all of your equity accounts. Now remember, the balance sheet is created as of a specific day in time. So unlike the other financial statements that cover a period of time, the balance sheet shows our assets, liabilities, and equity on a specific day. It also provides information about resources, obligations to creditors, and equity in net resources. It also allows stakeholders and users of financial information to predict amounts, timing, and uncertainty of any future cash flows. The balance sheet is also the accounting equation, which we recall is assets equals liabilities plus owner's equity. Assets are future economic benefits such as cash, accounts receivable, notes receivable. They can be long-term assets, they can be short-term assets. Short-term meaning they're going to be liquidated within the next year, and if they're long-term, then they're going to be used for many more years to come, or at least more than 1 year. Liabilities are your obligations of the business. It can also be the creditor's claims on the assets of the business, and equity represents the owner's claims on the assets. Sometimes this is also called stockholders' equity, depending on the type of company. So if it's a corporation, typically you would see this called stockholders' equity. So what's the usefulness of the balance sheet? Well, firstly, it gives us the ability to analyze the liquidity of the company. And we can use financial statement ratios to do that. So liquidity shows the ability of the business to pay their current obligations as they come due. Solvency shows the company's ability to pay long-term debt as they mature. Now, as useful as the balance sheet is, it still comes with some limitations. Recall that assets, at least most of them, are recorded at historical cost via GAAP's historical cost principle, like property, plant, and equipment, notes payable, and accounts payable. However, some things that are on the balance sheet require judgment or estimates on the part of management. For example, bad debt expense, warranty expense, and long-term asset useful life. So when you purchase a new piece of equipment, management has to determine how long they plan on that asset lasting. Is it 5 years? Is it 10 years? And they also have to determine which method of depreciation they're going to choose. Bad debt expense. Well, what amount of our current accounts receivables do we anticipate never collecting? Is it 2% of sales? Do we use an aging schedule? So depending on how old they are we going to collect a certain percentage of those? In addition, there's some things that are just omitted from the balance sheet. For example, the talent and knowledge of our employees. So the balance sheet is very, very useful, but it still has its limitations.